Hello, everybody. Welcome back to the Brief Life Lessons YouTube channel. As always, my goal is to share insights that can add value to your life in as little time as possible. My motto is small videos, big value, so I intend to deliver value to you guys and presenting these as quickly as possible. Today's topic is buying the dip, and I know this is a popular topic in investing, and especially as we head into seeing one of the major indices, the S&P 500, enter bear market territory. And for a lot of long-term investors, buy and hold and dollar cost average and buy the dip tend to be heavily repeated phrases and widely accepted methodologies for how to invest. So today I want to talk about why I'm not buying the dip, and I'll show you some reasons why, and I'll give you some macro technical analysis, and I'll just give you an idea of how I'm seeing the market today. As always, your investment decisions are up to you. I'm not a financial advisor, and you're responsible for any investment decisions you make. So let's dig right in. Here's the S&P 500 technical chart. I have this set for all time. So here's a look at the S&P 500 through all time. And I'm going to zoom in here, get it to just about right here. And as you can see, from about March 2009 up to, we'll say, right at the year end 2021, we've been in a very serious uptrend. The market has had, it has its dips, it has its up and downs, especially if you zoom in on a one day. There's lots of dips, lots of up and downs. But you look at the all time, you zoom out as a long-term macro investor. As a long-term investor, you're in an uptrend and you like what you see here. Even in the coronavirus, you have 1, 2, 3 months of a downtrend. So it's not a very long downtrend, and we know we came out of that with that V-shaped recovery. And then you look at beginning of year 2022 down to the present day, which is June 18th. And we're finally hitting a little bit of a downtrend. So that's the first thing I like to do when I'm looking at the market, is identify, is the market in an uptrend like we had been for so long, or is the market in a downtrend where, we've had more than one quarter. Here we just had one quarter of a decline. Here we've had about half a year of, the market being in a declining trend. So I think that's the first thing I like to look at. Second thing I like to look at on these macro charts is key levels. So key levels are being determined by looking at support, resistance, and polarity. Those are pretty basic technical analysis topics. You can find YouTube videos. You can Google information about those, and you can kind of get an understanding of what those are very quickly. So it's somewhere where the price is hitting a level and it's either bouncing off in the same direction or breaking through in a new direction. So I think if you zoom way out, this is a good example. Our 2000 market crash here, the rebound happened around this 775 level where I've got my blue line. And then you can see the 2008 crash, it comes down to right about the same area before it picks up steam again. So this is support for the market in both situations. The price tries to come below this 775 level and it bounces off. It tries again, and this is March 2009 versus 2002 here. So you're talking 6-7 years difference between the price hitting this level and the price hitting this level again, and both times bouncing off. So that's what I'm calling a key level. And you like to establish those key levels because it can give you an indication of whether, the index might be at a point where it's maybe going to stop or maybe be tested by one of those key levels, or if the trend will continue to accelerate. And on this macro chart, I found a key level around this 4130 area. As you can see, we've got a touch point right here, candle ending right here, a very thin and volatile candle here, and a candle starting here as well. So we've got a lot of touch points in this area, and as you can see, we've broken well below that area. And as I look back at the chart over this way, I'm not really seeing any other key levels until maybe about here at this 3510 blue line level. We've got a touch point here, a candle beginning here and just another touch point here. So again, that's how I'm looking at these key levels. And so I could see the market breaking down to about this 3,500 area before we possibly see a testing of that key level. So right now, I'd say we're kind of in a little bit of no man's land, at least on this macro chart. You don't really see any kind of macro key level support or resistance or polarity established here. So that's one of the things I'm looking at. And some of these other key levels I just have drawn on so you guys can kind of see these are the points I'm looking at that have multiple touch points, places where during this downtrend I'd maybe look for, if the indice gets to those levels, I'd look for it to maybe bounce off. So those are key levels. And then I just wanted to look at 2008 as a comparison, as that was the last time the market was in a recession. And I just wanted to compare that to today. So I'm going to move in. These are now daily candles. These now represent the price action of one day in the market. And I'm going to go back to 2008. And here's a look. 2008. As you can see, again, identifying the trend is really important. So we're starting to break into this downtrend within the market. And I looked at the lows of this downtrend. So here's a low, here's a low, here's a low, here's a low, and then over here is another low. So as you can see, the market is in this trend. Again, the market goes up and down, but it stays within this trend. And what I did was I looked at these key lows. Of course, they're a little bit outside of the trend, but they're key lows. So here's a key low. Here's a key low, and here's another key low. And as you can see, once the market finally broke those key lows, it had a major drop off. And you look at how that compares to today. Here's our trend. I've got a trend channel here with highs as touch points and lows as touch points. And then I've got my major lows, which I'm connecting with this trend line. And as you can see, we're maybe just starting to break through one of those key lows. So we're maybe just going to see, like we did in 2008, where this trend really accelerates to the downside. I'll go back to that for 1 second. As you can see, 2008, we were in the trend. We broke through some of the key lows right here, and then we saw a big move to the downside, a big acceleration of that trend. So that is kind of what I'm looking for today, and that is why I'm not buying the dip yet. And again, as I move back out to this all-time and I look at these monthly candles, I don't even see a dip yet on these monthly candle charts. And I like to zoom out because I'm a long-term investor. And so when I zoom out, I don't even really see a buying opportunity or a quote-unquote dip. Sure, if you zoom into some of these weekly and daily charts, you'll see that there are local dips. But really, there's no key level supporting this price, and the price is in a downtrend, and I don't really see a dip opportunity yet. Some of you may say, you wait for the perfect dip opportunity. Are you ever going to buy in, or are you going to miss out on a good opportunity? So I'll go back to 2008 on the daily candles. 2008. And the high is about 1575 here in the market, and the low is right about 670. And I measured this peak to trough. I measured that as about a 57.5% loss on the market. And if you looked at these macro candles, if you're a long-term investor and you want to establish when is the market back in an uptrend, that's when I want to buy. I would say even if you looked at this second uptrend candle and you bought at the top of this second uptrend candle right about here, 1575 here, the peak, and you're looking at about 890 here. And I measure that as about a 43.5% peak to the top of this second uptrend candle, the second green candle here. So the whole thing, peak to trough, again, 57.5, but peak to the second candle, you're looking at 43.5%. So I think that's still pretty good to buy stocks, indices at a 43.5% discount. You're only losing a little bit, and it's going to be nearly impossible to time an exact bottom, as we know. But if you were to panic and quote unquote buy that dip here, this is about where we are when you look at that current 2022 trend. We're right in this area where we're breaking near that key low. If you were to buy about here in 2008 at this 1150 level, right about here, peak to this 1150 level is 26%. So you'd be buying at a 26% discount if you quote unquote bought the dip. Whereas if you waited and held cash and saved cash and you put a lump sum in once you saw that the market reestablished an uptrend, you'd have bought at a 43.5% discount versus a 26% discount. So again, that just kind of gives you a look at how I'm seeing the market. I like to identify the macro trend. I like to zoom out, and I like to say, is the market in an uptrend or is the market in a downtrend? Then I like to look at the key levels on the macro picture to see where I think the price action could move to next and potentially bounce off of. And again, I just did a quick comparison to 2008, where when you look at these trend lines and you look at the major lows within the current trend line, the market doesn't move into that market capitulation phase or that low until we have a serious acceleration of that downtrend. And we just haven't seen that yet up here. We're still in this kind of a downtrend here, and we haven't seen a break where that downtrend is seriously accelerated. And so that's why I'm choosing to not buy the dip or buy yet. I do intend to buy when the market goes lower, but I think there's more room for that to follow. If you enjoyed this video, hit the like button. Leave a comment. Let me know if you agree or disagree with me. I know this may be a new concept for many of you. And maybe we'll revisit this video and see if, my assumptions held up well, or if this video doesn't age well. We'll maybe revisit that and take a look. And again, hit that subscribe button if you'd like to see more content like this. And I'll just make one more quick note here. A guy that I've learned a lot from in regards to macro level technical analysis is Hostile Charts on Twitter. At Hostile Charts, he's posting charts usually daily, definitely weekly. He's posting a lot of macro charts. And again, as a long-term investor, I still think there's value in technical analysis. And if you want to check out some of his charts, I think that'll help you in your approach to how you invest in the markets in the future. As always, thanks for watching and have a great day, guys.